It is Man and Markets, and on Man and Markets, our commitment to bring you the latest news within the region and also try to bring you the captivating stories of those that have made it in business, our entrepreneurs that are doing a lot of work to actually make it happen in the business world. To start off, BAT is a brand name, always a brand name in this country, and for years, this company was among the biggest taxpayers. Now, today, the company is struggling to move from what it was to a new entity or a new company for that matter. Now, those that understand the power of branding, this company is trying to come up with a new brand. But how do you handle this in a market where you're not supposed to advertise? As you know, cigarette advertising is banned. Let's pick the mind of the head of BAT East Africa to try and find out how they're trying to circumvent this challenge.
Performance was a commendable performance. In terms of gross revenue, we increased the gross revenue by 7% in 2019 versus 2018 to about 164 billion Uganda shillings. And this was driven primarily by sale of product, an improved product mix. So that means products of higher value resulted to a growth in gross revenue. This had a knock-on effect on the amount of taxes we paid to the government. This increased by 6% from 90 billion Uganda shillings to 96 billion Uganda shillings. For the shareholders, profit increased by 14%, which resulted to an increase of their dividend per share from 280 shillings in 2018 to 230 shillings in 2019. Consumers are really stretched from a tobacco point of view. And for us as a company, we needed to make sure that we are getting to every corner of the country to make sure our products are available. One of the biggest challenges we face is illicit trade. And in our estimation, 1 out of every 5 cigarettes sold in Uganda are illicit products. And illicit then means that they are not paying duty to the government, thus the Ugandan government is not getting the benefit of its citizenry spending money in that product. That is number one, illicit, and the impact has had on performance. Number two is regulatory impact. As you know, the industry is very regulated under the Tobacco Control Act and also regulations, tobacco control regulations. The tobacco control regulations came into effect last year. The impact of this is that we as an industry will have to invest in changing our packaging. Obviously, that comes at a cost, but we understand from our health point of view, the government wants to change the health warnings from text health warning to graphic health warning, which we as an industry are not opposed to. The thing that we were requesting for is the Ministry of Health and the industry should have had better discussions to ensure that the implementation does not impact the industry. Because what you'd have stocks, you'd have wrapping materials, which you need to deplete. So the lack of a two-way conversation to agree on how to implement it in the best way possible for the Ministry of Health, for them to achieve their agenda, and for we as an industry to achieve business objectives was not very smooth. Last but not least is digital tax stamps, which addresses the first issue I raised, which was illicit trade. So this was implemented. We've implemented on all our products. It comes at a cost. The thing that we'll be seeking from the government is to now ensure that the people who are not compliant then need to be brought to book, because it costs us money. We need to ensure that the other people are also implementing this, because we believe this is one of the solutions for tackling illicit trade. regionally, the biggest challenge for the tobacco industry is illicit trade. When we, through our third parties, try to find out the type of products or which products are being sold into Uganda as illicit, and vice versa in Kenya, where our sister company operates, how this issue will be resolved will be key for the industry, and the legitimate players will benefit. So the number one challenge for the regional business is illicit trade. The second one is regulation. That regulation needs to be balanced. We have to try and make sure we are adhering to the health agenda of the government, but we must also remember that our businesses are legal businesses and must also be allowed to operate. VAT shares, there is a concern, and one of the questions raised during the AGM is the stagnation of the price of the VAT share. And the caller who raised the issue raised the fact that at 30,000 shillings, first, the share has not been traded for a long time, and the price seems to be high. Our answer to that is that the stock exchange is an open market and is driven by supply and demand. So we will have to let the forces of supply and demand manage the price. We as a company cannot intervene with the price of the shares on the stock exchange.
Well, the East African retail market seems to be getting a little tricky for the multinational players. The latest we are hearing in Kenya is that South African retail giant ShopRite has already closed a second store, and over 100 workers have been laid off. Let's find out what exactly is pushing these companies to the brink. The East African retail market continues to generate turbulence for multinational retailers, with ShopRite Holdings, Africa's largest supermarket chain, being the latest to plunge into the region's retail headwinds. The firm has announced that it will lay off 115 workers and close its second branch in Kenya in less than 5 months, citing reduced flow of shoppers. This is coming on the heels of the Pep store winding up of operations in Uganda last month, which also cited reduced business for the business closure. ShopRite, which opened its first store in Kenya in 2018, has informed the Workers' Union of the closure of the City Mall's branch in Nyali, Mombasa, and job cuts. The retailer, which is retreating in countries outside South Africa, in April closed its Nairobi Keren branch, shedding 104 jobs. Its reduced branch count comes amid increased competition from cash-rich retailers such as Naivas and Carrefour in a sector where local retailers like Tuskys are struggling with lower sales and mounting dates. When setting shop in Kenya, ShopRite said it was taking advantage of the disarray in the Kenya's retail sector. Two of Kenya's 3 top retailers, Uchumi and Nakumatt, were in trouble, with the former having closed stores in Kenya. In Uganda, Uchumi and Nakumatt also closed operations, leaving behind a streak of unsettled dates and affecting business at both Garden City and Oasis Mall, where they were anchor tenants. ShopRite, 17% owned by retail tycoon Crystal Weizi, has grown from 8 supermarkets in 1979 to a no-frills mass-market grocer with operations in 15 African countries, including 2 stores in Uganda. ShopRite Holdings said Monday that it was considering reducing or selling all its stake in its Nigerian subsidiary. The company has been reviewing its long-term operations in Africa as currency devaluations, supply issues, and low consumer spending in Angola, Nigeria, and Zambia have weighed on earnings. ShopRite, which owns more than 2,800 outlets across Africa, said in a trading update that it was pursuing the sale after reviewing its operations model and receiving approaches from various investors. We will now take a very short commercial break. Don't go away. Man and Markets continues.